Hey guys, so in this video, I'm going over my top 6 stocks for the month of April 2021. I've spent the last month analyzing hundreds of stocks, and this is my list of stocks that I think are the best buys right now. Be sure to watch all the way through to get my full analysis on each of these companies. I'm going to go over key numbers, recent news, and why I expect them to grow. Huge shout out to Private Internet Access for sponsoring this video, so let's get started. The first company on my list is Square, stock ticker SQ. This is an American financial tech company from California that makes point-of-sale software and hardware and also offers financial and marketing services. Right now, Square is trading at $213.60 with a 52-week low of $42.33 and a 52-week high of $283.19. If we take a look at the 1-year price chart, we can see just how rapidly this company has grown. So starting from about 1 year ago, last April in 2020, we can see an almost linear growth all the way up to about $275 per share, with a recent sell-off bringing it closer to $200, meaning this could be a great time to get in right now. Square has a market cap of $97.106 billion, a PE ratio of 485.45, which is absolutely insanely high, an earnings per share of 44 cents, and they do not pay out a dividend. We can see that Square has a 5-year price to earnings growth ratio of 4.10 and a price to book ratio of 36.21. Looking at their profitability, we see a profit margin of 2.24% and an okay return equity of 9.69%. The revenue in the last 12 months was $9.5 billion. They have total cash of about $3.85 billion, and they have a pretty good current ratio of 1.88, meaning they have 1.88 times the current assets as they have current liabilities. It's always interesting to see what the analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts currently rate Square as a 2.3, meaning it is a buy. And the current analyst average price target is $266.60, which is over 20% higher than the current price of $213.60. Right now, Cash App has over 35 million monthly active users, and that number is going up each and every day. Profit is up over 200% thanks to this highly successful platform, and really they're just getting started. Gross payment volume on Cash App hit $377 million in the most recent quarter, which is up 162% from last year. And also from 2012 to 2020, total gross payment volume went from $6 billion to over $110 billion. And what's crazy is that Square is paying under $5 to acquire a customer for Cash App, and they are netting an average of $41 in gross profit per user. Although Square is definitely very overvalued on paper, the upside for this company is crazy. They are less than 2% penetrated for the P2P Cash App business and 3% penetrated for their point of sale business, meaning that if the digital payments market reaches $2 trillion in the next 5 years, which it very well could, and they continue getting market share, then we will see exponential growth in Square's numbers. The last couple months have seen quite a correction in Square's price, and that's why I think right now is a great time to pick up more of it. This is one of those stocks that you hold for a long time and make a lot of money doing so. So yeah, don't buy the stock if you're just going to trade it short term, because you very well could lose money doing so. But in the long term, this one's going to be a great hold. The next stock on my list is ABBV, stock ticker ABBV. This is a biopharmaceutical company that manufactures and sells many different products like Humira and Imbruvica, among many others. Right now, ABBV is trading at $105.98 with a 52-week low of $71.43 and a 52-week high of $113.41. Looking at their 1-year price chart, we can see that this stock went from about $75 1 year ago all the way to about $95 a share, and then we saw a correction bringing it back down to around $80 in November, and since then it has shot up in value and stayed relatively consistent near around $105 to $110 per share. ABBV has a market cap of $187.037 billion, a PE ratio of 38.96, earnings per share of $2.72, and this is actually a pretty great dividend stock with their dividend yield currently at 4.91%. Their price to book ratio is 14.15, which is quite high. They have a profit margin of 10.08% and a very good return on equity of 187.7%. In the last 12 months, they hit a revenue of about $45.8 billion. They currently have total cash of $8.49 billion, but their current ratio could be a little bit better. Right now, it's sitting at 0.84. Now, as far as what analysts say, right now they are rating ABBV as a 2, meaning it is a buy. And the average analyst price target is $122, which is almost 20% higher than the current price of $105.98. So besides being a great dividend stock, one reason why ABBV ABBV is an attractive stock is because of the forecasted performance for this year. They are forecasting an earnings per share of $12.40 for 2021, which in my opinion actually makes ABBV stock a pretty well-priced stock right now. Just last year, ABBV closed on its $63 billion purchase of Allergan, which is the creator of Botox and a huge cash cow company. This was a pretty controversial acquisition, but I do think that it was a smart move. Humira, which is AbbVie's lead cash cow drug, will start seeing competitors in 2023. And although this will have an effect on revenues, that drug will remain a cash cow. Also, I am a big believer that Allergan's products will continue to do well with decreasing taboo over medical aesthetic procedures throughout the US and the world. So yeah, this will only add to AbbVie's cash revenues. In the last quarter, we saw Berkshire Hathaway buy up 4.27 million shares, which is always comforting to hear. I'm sure Buffett likes AbbVie's consistently growing sales and earnings, low valuation compared to many other companies, as well as its strong dividend. Though not a terribly high growth stock like others on this list, I have full confidence that AbbVie will continue innovating and delivering good news to investors. Plus, its dividend of almost 5% is a great perk that almost ensures your money will grow. This is a solid long-term investment that will contribute to a diversified portfolio. So yeah, that's why I will be picking up more shares of this company. So I wanted to take a second and thank this video's sponsor, Private Internet Access, the world's leading no-logs VPN. Private Internet Access is the best at hiding your IP address and keeping you safe online. I take my online security very safely, and you guys, this is one of those tools you really should get at some point. With Private Internet Access, all your internet traffic is encrypted, making your internet use anonymous and a lot safer. You also get benefits like being able to access geo-blocked content on streaming sites, and it conceals your location and identity when working remotely. For example, I deal with sensitive information all the time when working from home or when traveling. When using public Wi-Fi, I like to have that extra bit of security that comes with using a VPN. What I do is I'll go here, set my location to anywhere in the world because they have the largest server fleet in the industry, and I'll click the turn on button. PIA works on all platforms from laptops to mobile phones and smart TVs with one subscription protecting up to 10 devices at the same time. So yeah, your entire digital footprint can be protected. Right now, you can use my link and get 2 years plus 3 months free for only $2.59 per month, and they also have a 30-day money-back guarantee. To me, that is an incredible investment. I'll drop the link below, so definitely go check them out. And now back to the video. Third on my list is Uber's stock ticker UBER. This is a tech company that was founded in 2009 that has services like ride sharing, food delivery, and more. So right now, Uber is trading at $54.71 with a 52-week low of $21.67 and a 52-week high of $64.05. Uber was hit pretty hard at the start of the pandemic, just like other rideshare companies. And we can see that their price remained in the low to mid 30s for a long time until November, when their price suddenly shot up. Since then, the price has been quite volatile and hovering between $50 and $60 per share. Uber has a market cap of $101.679 billion, no PE ratio because they are not yet profitable, and yeah, that equates to an earnings per share of negative $3.86. Their current price to book ratio is 8.17, and yeah, looking at the profitability, this company does not look strong. Their profit margin is negative 60.76%. But yeah, really when you're buying this company, you are betting on the future. You're not really betting on any profitability right now. Its return on equity is also negative at negative 46.92%. In the last 12 months, Uber hit revenue of $11.14 billion. And looking at their balance sheet, right now they have total cash of $6.83 billion, and they have a pretty good current ratio of 1.44. Right now, analysts are rating Uber as a 1.8, meaning it is a buy, and the average analyst price target is $69.05, which is almost 30% higher than the current price of $54.71. So when looking at rideshare companies, it's important to note that we need to consider the current negative profitability of them, as well as the future of driverless cars. If you don't think that Uber or Lyft are going to be able to cut drivers at some point and replace them with self-driving vehicles, then this is probably not the best stock to buy. I personally do think that it is very well in the future of ride sharing, so that's one big reason I really like Uber. Yes, profit margins are still very negative, though Uber is less negative than Lyft currently. They both are growing significantly, but yeah, profitability has always been an issue. Uber is still the global leader in ride sharing, as well as a global leader in food delivery. While most of its revenue comes from ride sharing and food delivery, Uber really is a mobility platform with about 150 million monthly active users. Delivery gross bookings for Uber Eats grew 110% year over year, which helped offset losses from the pandemic. The recent passing of Prop 22 in California means that they are still able to consider drivers as independent contractors, which is good news for this company. But at the same time, they recently lost a ruling in the UK saying that drivers must be treated as workers instead of as self-employed contractors. Overall, I do think that Uber should be a great long-term pick. And you're really betting that as a mobility company, they'll be able to reduce costs and gain more market share. That's one reason why I'll be betting big on Uber this month. The next stock on my list is the Vanguard Growth ETF, stock ticker VUG. This is an ETF from Vanguard that tracks the CRSP US Large Cap Growth Index. When you buy this, you're basically investing in a lot of high growth companies that I believe in. So yeah, it can definitely be a safer and more diversified way to invest than buying individual companies. If we take a look at the VUG page on Vanguard's website, we can see that there is a quick proc summary. It just basically states that this is trying to track the CRSP US Large Cap Growth Index like I previously mentioned. Right now, one share of this ETF is trading at $255.18. And yeah, if we look at the performance, you can see that in the recent year, this one has done extremely well, hitting about 40% average annual return. In the last 3 years, we've seen a return of about 22.98%. And since its inception in 2004, the average annual return has been about 11.3%. One thing I love about this ETF is that the expense ratio is just 0.04%. This is extremely low compared to other ETFs. And when the fees for ETFs are this low, this just means that your money is growing faster. And yeah, it feels good to not have to pay a lot of fees. In last month's video, I know I covered ARKK. And just to give you guys some perspective, the expense ratio on that one is 0.75%. So almost 20 times higher than the expense ratio on VUG. Vanguard rates this as a 4 out of 5 on the risk scale. And we can see that they have a total of 258 different stocks with total net assets of $144.8 billion. And some of the largest holdings in this fund are Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Visa, Nvidia, MasterCard, and PayPal. So yeah, if you like companies like those, then this is gonna be a great fund to invest in. So the CRSP US Large Cap Growth Index, which this fund tracks, is a bit higher risk than ETFs like VOO, but not as high risk or high growth as funds like ARKK, which is Cathie Wood's innovation ETF that I've talked about in an earlier video. The companies you're investing in with VUG are high growth, large cap companies. So yeah, usually in these videos, most of the companies I talk about are gonna be higher growth and hence more risky. In the past decade, these companies have far outperformed the market, and that is why I'm a fan of this ETF. If you combine this with ARKK, VOO, VTI, and maybe an international stocks ETF, then you will really have a well-rounded portfolio. But yeah, VUG has performed very well in recent years, like I showed you, and it's a great way to invest in high growth companies without taking on as much risk. Plus, like I mentioned, that expense ratio of just 0.04% is extremely attractive. Next up on my list is Palantir, stock ticker PLTR. This is a US-based software company that specializes in big data analytics for big government agencies like the FBI and the CIA. Their main products help companies manage, integrate, and secure their data. Right now, Palantir is trading at $22.58 with a 52-week low of $8.90 and a 52-week high of $45. This stock is wild. It's extremely volatile, as you'll see in the one-year price chart. But yeah, just 1 year ago, this stock was trading under $10, and in November of 2020, it spiked in price, remained around the $25 to $30 per share value for a few months, saw another huge increase in price at the end of January, and since then, the stock has tumbled back down to just over $20 per share. Palantir's market cap is $41.147 billion. They don't have a PE ratio, they don't have an earnings per share, and there is no dividend. Look at the valuation measures, we see a price to book ratio of 27.02, which is very high, which means it's definitely overvalued on paper. And for the profitability, we see a profit margin of negative 106.75% with a return on equity of negative 139.76%. So yeah, on paper, this company does not look strong at all. They're sitting on about $2.01 billion in cash, and they have a current ratio of 3.74, which is definitely one of its strong suits. Now, a lot of analysts don't like Palantir, and they're rating it as a 3.4, meaning it is between a hold and an underperform. And the average analyst price target is $25.83, which is about 15% higher than the current price of $22.58. So yeah, like I said, we recently saw a drop in prices for Palantir after a really big run-up. And this could mean a great entry point for long-term investors. On February 18th, Palantir insiders were allowed to finally sell their shares and lock in some profits, so this is one reason for the drop. Recently, we saw Cathie Wood add 1.2 million shares of Palantir to her ARKK fund. Now, this is a very volatile stock, and even the CEO has been frustrated and warned short-term investors to back off. Long-term investors will know how attractive the company is with its long-tail revenue model, meaning contracts with the government and other clients get more and more lucrative over time. If you look at how good Palantir's products are based on reviews, you'll also get some new confidence in the stock. So yeah, overall, I do think that this stock could be a great pick for long-term investors, but short-term holders may win or lose depending on the current volatile market. I'll be adding more of it to my portfolio because I do think that it will be a great long-term win. Next up on my list is Carnival Corporation, stock ticker CCL. This is an international cruise company that operates over 100 vessels across 10 cruise line brands, such as Carnival, Holland America, and Princess Cruises. Right now, Carnival is trading at $26.06 with a 52-week low of $7.80 and a 52-week high of $30.12. CCL was hit hard by the pandemic, saw its price shoot up in June of 2020, back down after investors realized that cruising would not start up for a long time, and since November of 2020, this stock has performed quite well. Right now, the market cap for CCL is $30.145 billion. There's no PE ratio because they are not profitable right now with an earnings per share of negative $13.21. Their current price to book ratio is a pretty low 1.47, which means that this company is close to being undervalued. But yeah, one reason why this company is struggling so much right now is because of the profitability. Because cruises have not been allowed to operate, their profit margin has been hit hard, sitting at negative 182.98%. Return on equity is also negative at negative 44.58%. And in the last 12 months, they had a revenue of $5.59 billion. They're sitting on total cash of $9.51 billion, and they have a current ratio of 1.22. So this is probably the strongest cruise in terms of its balance sheet, meaning that they are the most likely to survive if this pandemic drags on even longer. Right now, analysts rate this as a 2.9, meaning it is a hold, but we can see that the trend is shifting definitely towards being a buy and a strong buy. Now, for the average analyst price target, it's actually lower than the current price with an average of $23.36, which is over 10% lower than the current price of $26.06. So Carnival is another volatile reopening stock because a lot of the sentiment is based on when cruise lines will be allowed to start sailing again. As of right now, the CDC says that November 1st is still the first date that sailing can begin. We saw it bounce up and down prices recently because the CLIA, aka the Cruise Lines International Association, had made a public plea asking the CDC to allow sailings starting in July. But that plea was declined. Compared to other cruise companies, CCL has more cash on hand with about $9.5 billion at the end of Q4 2020. The bad news though is that their debt has soared to $27 billion, which will have a big impact on the long-term profitability of this company. Their interest payments are also going up significantly, but with cruising starting sooner than November globally, we should expect to get some much needed revenues in this year. Right now, share prices are still close to 50% under pre-pandemic levels, and I think that once cruise operations are back to normal by 2023, they should see a continual recovery in prices. This is definitely not a short-term hold, but if you are willing to hold for multiple years at least, then I do believe that you should see a great return on your investment with CCL. So those are my top stock picks for the month of April 2021. As always, I want to make sure that you guys do your own due diligence before investing in any stocks. Just because a stock is on this list does not mean you should just go out there and buy it. You definitely need to do your own research, and I recommend doing at least 1 hour of research per company that you invest in. I'm not a financial advisor, and you guys should use this video for entertainment purposes only. Use it as a starting guide, and if any of these companies look attractive to you, go out and do your own research. Anyways, if you guys want some free stocks, definitely check out the links below. You get 1 free stock from Robinhood or 2 free stocks from WeBull. The markets right now are volatile, so use extreme caution when investing large amounts of money. Investing for the short term is always more dangerous than investing for the long term, so that's why I recommend most people buy strong companies that you really believe in and just hold them for a long time. That is the best way for you to make money investing in stocks. I hope you guys got some value out of this video, and if you guys did, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.